Hey, welcome back. Recently, we saw a massive decrease in China's lithium demand, and overall the price of lithium is down quite a bit lately. This can open some very good opportunities in the sector, and I believe there are more than a couple of really interesting lithium companies out there, as you are about to see. I saw something funny that we unfortunately keep seeing in the market, and I wanted to show you. When the stock prices were booming, everyone was rating these companies as buys, but now that the price of lithium is falling, these companies suddenly become a sell? To be honest, the best approach is probably the opposite of what they say. This is something we see especially for commodity producers, and it just shows how these people have no idea what they are talking about. Commodities are cyclical by nature, and it's very simple to understand it. When the price is low, companies make less money, with some of them even losing or going bankrupt, and nobody is investing in new projects with low prices in mind. This results in a lower production, meaning supply, and if the demand is stable or it goes up, it pushes the price up. When this happens, everyone is interested, everyone makes a lot of money, pays massive dividends, and everything is so good. This is when the stocks usually jump 2, 3, 5, 10x and everyone suddenly tells you to buy them. However, this increases the supply, and if the demand is stable or it goes down or it doesn't increase enough, then you suddenly have to cut the price if you want to sell the commodity, and the cycle repeats. As with almost any commodity, lithium is very exposed to China's demand because this country alone is responsible for around half of the global demand. If there is any issue with China's demand for any reason, we can expect lithium prices to be affected, like we see today actually, when China's demand fell by around 50% in Q4 2023. Now, China also has a massive share of the global lithium supply, and this share is increasing at a very rapid rate. If this continues, I think that finding an independent company that has even a tiny bit of that market can prove to be very valuable in the future. Of course, we also have to remember the risk of alternatives to lithium in EV batteries, for example. When talking about EV batteries, we are still looking at new technologies, and just because lithium is very popular today, it doesn't mean that it's going to be part of the dominant technologies in a decade or two. Not only that, but we have to remember that lithium is not that rare. It's more abundant on Earth than lead and tin, for example, which are fairly common elements, but the limit to lithium production is rather in the cost. You simply don't pay, let's say, 5,000 to get 2,000 from the lithium. However, if the incentive, meaning the price of the commodity, is high enough, then you can see a big increase in supply, so there is always going to be some kind of resistance to how high the price can go in the long term. On top of that, if the price is too high, then there is also a bigger incentive to look for alternatives, which can affect the demand. Anyway, if you are interested in the subject, make sure to check out this video next. Before we get into the companies, I want to make it clear what I'm looking for in a mining company in general. The most important thing that I want is that the company is able to stay afloat during bad times and do amazing in good ones. As you can imagine, the second part is easy and pretty much any company is able to do it, but the first, as you are about to see with lithium companies, is not that easy. For this, other than having a low all-in sustaining cost, good financials are very important because you simply can't have a huge debt repayment in a year when you can't even know where the price will be in a month. This kind of things allows miners, and we've seen this before, to buy out their competitors during bad times, which can be very rewarding when the price goes up. Think about it, if the price of lithium doubles, any miner would be an amazing investment, but if it crashes in half, how many of them are going to survive? Since we can't predict the prices, an ideal miner should be able to withstand a bad period for an extended amount of time while the competition struggles, which can open very good opportunities. Now, to begin with this company whose name I've never been able to pronounce, Albemarle, I think, they are one of the biggest and most popular lithium producers, and the stock has been moving almost identical to the price of the commodity. They have operations pretty much everywhere but in Africa, and since they had a couple of good years, they plan to expand even more. Because of the falling prices, they recently had one of the biggest cuts in outlook I've ever seen. From 1.2 to 1.8 billion in net cash from operations, they cut it to 6 to 800 million, so less than half. Look, this is completely normal for the industry, and this is why I think that this kind of outlook is pretty much meaningless. The price of lithium can still crash even 50% from the current level, so you can't really rely on an outlook unless you sold all your production at a certain price in advance, which they didn't. Financially, they are doing very well, with the 7.1 billion in current assets being almost enough to cover all the liabilities. Even if the inventories are worth less than this today, they are still in good shape and 99% of the debt is fixed. Since they made a decent amount of money during the boom, they invested a lot lately and we can see the capex jumping from 850 million to around 2 billion in 2023. This is good for their production capacity and we can already see an increase, and they expect the volume to grow at a compound annual growth rate of 20-30%. Now, we don't really know how much they can actually produce on average, but at the current lithium prices, they should have a net income of around 1.5 to 2 billion. However, what if the price of lithium crashes another 50%, getting to the level from 2020? Well, we can look at the data from 2020 to get an idea, but keep in mind that today's production capacity should be much bigger, since we can even see a 50% increase in their property, plant and equipment. Back then, they made around 450 million during the whole year, so if we saw these prices today, they should be able to make around 700 million in net income. Based on their estimations, the free cash flow should be negative even at the current prices, but that is because of the high growth capital expenditures. Without them, they pretty much break even. The problem is, if the price of lithium goes lower or even remains around this level, the company may not produce enough money to fund the new projects and also pay back its debt. They will either have to pause them or issue more debt. Now, if you bought this near the peak, you as an investor not only barely got a dividend from this entire upcycle, but now you have to wait for a new one for them to finish what they started and maybe break even if the price of lithium jumps like 200-300%. This is why I keep saying how important it is to buy commodity producers at a good price, not when the market tells you to buy. Anyway, low prices can also represent a good opportunity for mergers and acquisitions, as we've seen recently with Allkem and Livent. These two are going to combine into Arcadium Lithium, but by the time we have data about it, we can look into both of them. Allkem is a lithium chemicals company that has projects in various stages in Argentina, Canada, Japan and Australia. The mine in Argentina that's currently running has a production cost of around 6,000 per ton, so they should have a good margin of safety. They own 2/3 of this mine and they are currently expanding it with plans to pretty much triple the production capacity in the long term. Now that they made some money, we can see of course a higher capex, which should be good if we see high lithium prices again. The plant they are building in Japan is pretty interesting. They want to use lithium carbonate that they produce in Argentina as feedstock to make lithium hydroxide in Japan to be used in batteries. You can imagine how many companies would like to have that, and Toyota already owns 25% of the plant. Financially, they are in a very good position, with 1.1 billion in current assets and only 450 million in current liabilities. These current assets are almost enough to offset the company's total liabilities, which is very good, especially when you consider the potential it has from the expansion and all the new projects. Plus, they have non-current assets of around 4.1 billion, most of which is intangible things. So I'd say that this half of Arcadium is pretty good, but let's see the other one. Livent is another lithium chemicals company with facilities in the US, UK, China and Argentina. They also have several expansion plans, and we can see that most of the capex goes into growth and they don't need that much maintenance capital. They have about $500 million in current assets, almost half of which is in inventories that may be worth less than that today. Still, with total liabilities of around 620 million and non-current assets of almost 1.9 billion, they should be fine. However, I'd say that if you compare the two companies, they are not equal. I mean, Allkem makes like twice as much money and they have twice as many assets, so a merger of equals is not optimal in my opinion. Still, they can integrate and generate more value, so overall you probably still win as a shareholder of any of them, but especially Livent. Now SQM, they have a very similar market cap to the first one, but they produce much more money and pay a very nice dividend. They have mines in Chile, Australia and China and are able to mine at a very good price, with the adjusted EBITDA margin in Q3 when the price is down still being at over 40%. The financials are even better, with the 6.2 billion in current assets being more than enough to cover all the liabilities, which is not something you see every day, especially for a mining company. They expect the capex from 2023 to 25 to sum up to around 2.2 billion including investments, which is what Albemarle plans to spend in a year. The issue, I think, is that it might be too low, and despite having the money they need to expend a lot, they seem to delay this process, and I don't think that's such a good idea when so many other companies and countries are interested in the industry. If they want to do this expansion in half a decade, who knows, maybe they'll have to pay 5 times more than today. Despite having a smaller production capacity, which is also reflected in the value of their assets, they are very profitable thanks to the lower production cost, being able to make over 2 billion per year in net income at the current lithium prices. This is also an advantage thanks to their dividend policy, in which they say they are going to pay 30% of the net income as dividends. In the future, in a good year, taking into account the investments, they could make 4, 5, maybe 6 billion in free cash flows. During an average one, they can probably make 1, 2 billion, and during the bottom, they would probably break even or maybe even make a bit of a profit, which is the type of mining company that I like. The dividend in these cases wouldn't be so great, around 7 to 10.5% in good years and 2-3% in normal ones, but they also tend to pay special dividends, which can lift it a lot. Of course, there is also the political risk, and Chile already has a pretty significant tax on natural resources. One thing to keep in mind about the country is that following the new president taking office, they kind of want to have majority control in the lithium projects, and we can see a very recent agreement with SQM that pretty much shows that. The agreement has the company giving up majority control in its operations to Codelco, who would get 50% plus 1 share, but they keep the rights to operate for another 3.5 decades and they are allowed to increase production. You can see this as a competitive advantage, but not having majority control makes them pretty much dependent on the politics, which we know very well can change. Overall, I think this one is the best company in the industry because they have such good financials, a nice dividend, a relatively low valuation and a low production cost, but you have to balance the risk and reward. And finally, Lithium Americas. This one is a small company with a market cap of around 1 billion. GM is the largest shareholder in the company, owning around 9% of them. They also have rights to whatever the company's new project will produce for a decade, and if you ask me, at some point it wouldn't be a surprise if they buy the whole company to secure everything they produce. We've seen this kind of investment from auto producers like Stellantis or Tesla before, and in the future it's definitely an opportunity to keep in mind for smaller lithium producers. They recently had a split into Lithium Americas and Lithium Argentina, but we don't have much data because this is very fresh. Lithium Americas is going to keep the project in North America where GM has interest, and about GM, they are also subscribing for around 330 million worth of shares in the new company, which is why I believe they might eventually buy them completely. Lithium Argentina has the other 3 projects in, Argentina. Now, what's interesting about this company is the fact that they barely produce anything. This is not really a miner, they are currently project developers, and these mines are either not finished or very recent. If you buy Lithium Americas or Argentina, you basically invest in a company that is investing in lithium rather than actually producing it today. As for the financials, Lithium Americas is in a very good shape. They have 220 million in current assets, of which 200 million is in cash, plus another 75 million in cash that's not included in this. This is enough to offset all the liabilities like 4 times, and it doesn't include the 330 million from GM, which is going to be used to develop the mine. So from a financial point of view, they are in an amazing shape, but we don't know how much the project is going to cost or when it is actually going to produce. They say that phase 1 should be over and production will begin around 2026 or 27, so there is still some time to wait. The life of the mine should be around 4 decades, and they expect to break even at around 6.75 thousand per ton, which would be very good. After phase 2 of the mine is complete, they expect to make even more than 2 billion depending on the price of lithium, probably something like 4 or 5 if we see the prices from a couple of years ago. Now I doubt it because SQM, which has not only a lower production cost but also twice the production capacity, made around 5 billion in the very good times, so we should be as conservative as possible with these estimations. Still, even if they make nothing at the current prices, 200 million at twice the price and let's say $500 million at 4 times the price, that's still very good for the company's market cap. Add the potential that they might actually be right, in which case this could be a 10-bagger, and I think that for me this might be a risk worth taking. The project they own is in the low part of the second half of the production curve, but this is not bad for America. Of course, we still have to wait and see the actual production before trusting these kind of numbers. Anyway, having a pure play North American lithium option is definitely something to consider, especially since they have all that support from GM and very good financials. Now let's have a look at Lithium Argentina. One of the mines began producing in the summer of 2023, and at the end of phase 1 it should produce as much as the American mine in phase 1, getting to around 60 kilotons per year after phase 2. But keep in mind that they own a bit less than half of the project and will get like 49% of the production. The other two projects are in very early stages, but they at least have a mine that can make like 40 kilotons of lithium by mid-2024. Now, the issue with this one is that we only have data for the two companies combined, but we can discount what we know Lithium Americas has from the total. This company has even better financials, with a 150 million in cash being almost enough to cover the roughly 220 million in total liabilities that would be left. I think this one is definitely something to look at again this year, especially after the separation is done and they produce more lithium. Still, take out the assets and liabilities held for distribution and you have almost 1.1 billion in assets and 220 million in liabilities, valued at whatever the market cap is today. Plus, this company is now actually producing lithium, and even if they make just 100 million per year on average, this is very cheap. If I had to choose one, I'd probably go for Lithium Argentina because the financials are exceptional and you don't have to wait for who knows how much before they begin producing. A risk that we can't really measure is the fact that we don't know when these projects are going to be done. We can see this project in Argentina, for example, taking over a decade from exploration to extraction. However, even if they take a decade to finish, they can always be bought by another company during that time, and locking in that interest in these lithium projects today can be very rewarding in half a decade, for example. We can see how much interest there is in the lithium in Argentina, for example, with this map that the company provided. In the very recent history, we have Rio Tinto, BHP, Stellantis, Livent, Chevron, Ganfeng, Glencore and many others that invested in the country. Again, projects, especially the ones that are good, are limited and they take a lot of time to become operational, and by investing in Lithium Argentina in this case, you buy a piece of 3 projects that someone like, let's say Tesla, might be very interested in the future. Now, a massive issue with all these companies is that they are relatively very small and produce a tiny amount of money. When you have giants like Vale or Rio Tinto who are 5 or 10 times bigger based on the market cap and produce in a single year more than some of these companies produced in their entire existence, it's very tough to compete. You know, the resources in the ground are the same and are, after all, limited. No government is going to take your offer when one of these companies offers 5 or 10 times more than you. Their size ultimately limits the lithium producers. A diversified miner has the potential to produce more lithium than many of the companies that I analyzed today, but now this depends on you. Do you want almost 100% exposure to lithium, or you want, let's say, 10% lithium, 20% copper and so on? I'm not saying one is better than the other, it ultimately depends on if you are looking for a pure play on lithium or not. Plus, there is also the increasing potential for one of the big miners to simply buy one of these companies. Vale and Rio Tinto, for example, make in a good year almost enough to completely buy one of the big lithium companies. At the end of the day, any of these stocks can crash 50% in a couple of months if the price of lithium drops, which is normal for any commodity producer, but the potential of lithium is really impressive. If we get into a scenario where the supply can't keep up with the demand for a few years, any of these companies can easily multiply, and I want to get this kind of exposure. Is the price of lithium going to fall even more? Maybe, which is why I think we should be ready and analyze these companies in advance. By the time the market calls them a buy again, the opportunity is probably gone. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.